Executive Officer at Bank of Maharashtra, is now joining us. Mr. Saxena, good morning. Shesha this side, and thank you for taking your time out. And first of all, congratulations. The stock of Bank of Maharashtra has now been added to the futures and options trading with effect from 26th of August. But other than that, let's also talk about credit growth, which continues to outpace deposit growth. Is the battle for deposits becoming your biggest challenge, and how do you plan to bridge the gap between advances growth and deposit growth?
Morning, Shesha. What you have said is not something specific to the Bank of Maharashtra, which is credit growth outpacing the deposit. This trend is visible in the industry, and I would say not in one or two, but last couple of quarters, last few quarters, the credit growth is outpacing the deposit growth. In our case, I don't see a major challenge. What we have been doing, in fact, is that we are also conscious of our margins at all times. So we have been very consciously looking at mobilizing deposits within which focus always remains on the low-cost component. We have been strategically during the last 10-15 months moving away from high-cost bulk, which was sitting in the balance sheet. And we have looked at alternate sources of raising resources. For example, we have done a lot of refinance transactions. Today, my refinance is almost crossed 19,000 crores. And here I get the advantage of a blended cost of 6.25 to 6.5, and where there is no CRR and SLR loading. And this helps me maintain decent margins also. So this is how we are looking at. We have kept a guidance of a credit growth of 17 to 18%, within which we are doing for this quarter also it is 24% for the domestic side. If I include my gift IBU, then the growth is 27%. And the deposit, which is to grow at 14-15%, we have grown deposits at 13%. Now, if you like, I'm just comparing for all the banks who have declared with their quarterly results or even the provisional numbers, the deposit growth for a PSP as a sector is 11%. But if you minus the CD issuances by the policyholder banks put together, it is 10% actually. Likewise, for private banks, the deposit growth visible to us is 14%. But you minus the CD, it is 11%. So its organic growth is 10 to 11%, wherein I have clocked a growth of 13%. So in the deposit also, we are doing better than the industry. There has been no single CD issuance in the Q1. And this also has been very consciously thought about and executed. What we feel that CD, we are not averse to do looking at the option, but it is ultimately a short-term measure. Max duration is 1 year. Also with CD, you are probably not going to get the cost advantage like I have been able to get in the refinance option. So that's how, and plus, ultimately, we are funding our credit growth with deposits and not through borrowings. So this is how we are looking at the credit and deposit side of the balance sheet.
So that's as far as the credit and deposit side is concerned. But let's also talk about credit costs, because they are now below that 1% mark. Is this the new normal, or should investors expect normalization as the loan book matures for you?
So we are very, very conscious on the asset quality, the new onboarding in whether it is a RAM segment or a corporate. We are very positive around what is the loan book that we are building today. It should comprise of good quality borrowers. So that takes care of the future. As regards the credit cost, today our guidance is to maintain it below 1. I am 0.99. But if you look at the credit cost as per the IRAC norms of the Reserve Bank, it is actually 0.40. So 0.4% is what my credit cost is. What is happening is I am also having a net NPA of 0.13, which is lowest probably in the industry today. And whenever any fresh slippages we are encountering against the requirement of 15% around, I am providing 100% upfront. So that is the reason why the credit cost looks 0.99 kind. But if I look at the REC norms, we are a credit cost of 0.4%, and overall guidance to investors has been to maintain it below 1.
Understood. And with ECL norms approaching very soon, Mr. Saxena, do you expect any meaningful impact on profitability or capital allocation as a result of this?
Shisha, we have been very closely tracking the guidelines and what is the impact going to be on us. So our calculations were in place, and even when the draft guidelines were there, the sense that we have drawn is 2,500 crores is what I would like to be providing for ECL. And what it translates to almost, because RBI has given a glided path of 4 years. You can do this up to 31st March 2031. So with that glided path given, we had worked out that my requirement towards ECL is going to be around 100 crores on a quarterly basis. As against that, even when the drafts were there, we have front-ended. We have done a 250 crore ECL provision. And as I just explained that we are actually providing more than the IRAC whenever we encounter fresh slippages. So our transitioning to the ECL framework will be very seamless, very smooth. I don't see any challenge on my profitability numbers, OP, NP, because of the ECL provisions. Well within our operations, whatever we are garnering, we will be able to make provisions. Rather, we are already advanced our provisions, and we like to do that to give the investors also that comfort that ECL is not a challenge for Bank of Maharashtra.
Okay, and your capital ratios also continue to remain healthy, Mr. Saxena. But you have kept the option of raising equity open. Under what conditions would you actually tap the market to raise equity?
So, Ashisha, what happens is, while you rightly observed, our capital adequacy is at a healthy number of 18% plus. But annually, during the beginning of the FY, we will go to the board and submit our capital raising plan for the full year. Then we have a process to take a regulator and the government approvals and the shareholders approval. So we will do all that and take the enablers, keep the enablers with us. As of now, there is no urgent, pressing need to raise equity. But I have approval to do a 7,500 crores of capital raising, both in the equity and the debt segment. But whether I will exercise the option, since I'm already adequately capitalized at 18.13%, there is no urgent need to raise money even for growth. We are able to sustain without any further equity raising. But as I said, we keep the enablers at the opportune time. If we see some opportunities and using the opportune mode, then we will decide during the year. With the approval in place, it is not mandatory that we will do the raising. But we do keep the enabler at the beginning of the year. Every year we do that.
Okay, so not mandatory that you will go ahead and tap the market, but you have just kept the option open. Meanwhile, Mr. Saxena, you're already operating close to a 2% return on assets. Should investors start thinking of Bank of Maharashtra as a structurally 2% ROA bank rather than a 1.7 to 1.8% ROA bank? Can we, change the ROA guidance in that case?
So our ROA guidance for the last 2 years, where I've been sharing at the beginning of year guidance to investors, is to maintain a ROA of 1.75, and which is a healthy, decent number, I must say. But if you see actuals, we have been overperforming. In fact, March 26 Q4, we did a ROA of 1.97. So aspirations are there to be seen as a bank which is in the ROA, 2 ROA kind of a club. But I want to go this path in a very calibrated manner. We know there'll be some quarters where you will see plus minus. I have ROA of 1.90 for this particular quarter, Q1 of FY27. There have been two reasons. My cost of funds went up by 5 pips. We had done some MCLR cuts during the last FY. This Q1 became the quarter where we had the full impact. But having said that, we have in fact upped our ROA guidance from 1.75 to 1.80. So as I said, while we aspire to be in the 2 ROA club, but we will like to do it in a calibrated manner. Against ROA guidance of 1.75 for the last 8 balance sheets, we have now upped the guidance to 1.80, and we will be continuously aspiring to perform over the guidance number. With 1.90 actual done in Q1, we are 10 bits more than the guidance. So that's how we would like to take it, ROA.
Right. So that's the guidance as far as return on assets is concerned. Mr. Saxena, thank you so much for giving us such elaborate answers and joining us here on ET Now with your outlook on what FY27 and the years ahead could look like for Bank of Maharashtra. Thank you for joining us today. With that, it's a wrap on this edition of the show. Thanks so much for tuning in. Buy now, sell now. We'll take all the market action forward. Stay tuned.